Welcome to the Gain in 60 Seconds Fastcast. Thanks for tuning in. As yields began to rise beginning in 2022, investors were piling money into Treasuries and money markets with the promise of higher interest. On the surface, a 5% yield on Treasuries sounds great when compared to the relatively nominal interest we had become accustomed to. And judging by the fund flow data in the first chart, investors largely took the bait, with the 20-year Treasury Bond ETF seeing almost $25 billion worth of inflows last year. But as inflation remained sticky and the Fed continued to raise rates throughout the year, the reward of higher interest quickly turned into capital losses as the fund posted an annual loss in excess of 10%. Wiping out any returns from the higher yield. As we adjust to what is looking more and more like the new norm of higher rates, it is important to assess more than just yield. One of the most important aspects to consider when analyzing bonds is duration. Without giving you the wordy official definition, the easiest way to understand duration is how much gain or loss would be experienced with a 1% change in interest rates. So a bond or bond fund with a duration of 10 would mean the investor would lose 10% for every 1% increase in interest rates. With rate expectations looking more and more uncertain, it is critical to analyze more than just yield, even for historically safe havens like Treasuries.